Okay, in this series of videos, we're going to take a look at Chapter 11, the sources of funds for residential mortgages. And in this chapter, we're going to be looking at kind of the process behind home loans and how they work, as opposed to the kind of the math involved with it. We're not going to look at how to calculate payments or how to determine the amount that a borrower can borrow, but we're going to look at kind of the process and the players involved in making home loans. So first we're going to start with two basic types of lenders. The first one is a portfolio lender, and this is typically going to be smaller banks, savings and loans, or credit unions. And the defining characteristic is that they hold on to the loans that they make and they service them, which is a special term that means basically they collect the money, they deal with any problems, they help arrange for the payment of taxes and insurance. They kind of do everything associated with that home loan. And the important thing is that they do not sell them on. Conduit lenders, on the other hand, are mortgage companies that make loans and then do sell them on. So these loans that are sold on are typically going to be pooled together and securitized. That is another way of saying that they're going to be turned into securities. So just like a share of stock or a bond is a security, you can take home loans from a number of borrowers, hundreds and hundreds, perhaps thousands of borrowers, pool them together, and then turn those into individual securities that people can buy. So it's possible that you could own a mortgage-backed security where it's backed by thousands of home loan borrowers across the country, and every time they make a payment, you get a little piece of that payment. So that's kind of the notion behind securitization and mortgage-backed securities. So the purpose of these conduit lenders is that they're making loans, or also known as originating loans, in order to sell them on or distribute them. So let's talk about the process here. We have warehousing. This is where there's going to be lenders that hold on to loans for a brief period of time until they get packaged up or pooled and then sold on in securities. And let's look at the mortgage banking process here. The first thing is going to be a loan commitment. This is indicative of a commitment to borrowers to make a loan. So if a borrower has been underwritten, if they have been determined to be qualified borrowers, then the bank basically makes a promise to make a loan at a certain date. So that would be the date when you close on your house. That means you've purchased your house, signed all the paperwork, done the deed, and you're going to get your loan at that time. So then there's going to be creating the loan and funding the loan. The loan closing is going to be frequently done with borrowed money from a lender, and this is strange, even from a lender. They're borrowing the money to make the loan to the ultimate borrower, that person buying the house. So this lender is going to have a warehouse credit facility or a warehouse credit line, which is basically a gigantic credit card, perhaps with $100 million on it. And they're going to fund loans by taking some money from this credit card and giving it to the borrowers. So during this process of loan closing and creating and funding the loans, there's this notion of pipeline risk, and that has two parts. The first part is the risk of fallout, and that is where the borrower doesn't follow through and close on the loan. Perhaps something comes up with the inspection of the home, or they lose their job, or any of a number of things can happen that would prevent a borrower or a buyer even from ultimately buying that house and using the loan to purchase the house. So that would be the first thing, fallout risk. And then second is interest rate risk. If interest rates rise, that means that the value of the loan is lower. This is a kind of a time value of money concept. We've dealt with that a little bit, but if interest rates go up, the present value of things go down. And so the lender, if they're making a loan and all of a sudden there's an increase in interest rates, they've just lost money on that loan that they've made. So that's another risk. After these loans have been created and funded, after the loan has been closed, then they are collected into pools. And so if we have FHA and VA loans, so that's the Veterans Administration and the, what is it? I think it's the Federal Housing Administration. If those loans, or when those loans get collected together, pooled together, they're used to create Ginnie Mae securities. So these are government National Mortgage Association. They're backed by the U.S. government, so they have kind of a particular set of characteristics and a set of borrowers that like to buy those kinds of securities. If you have jumbo loans, and these are loans, by the way, that are, well, it's kind of self-descriptive. These are going to be very large loans, so bigger than a normal loan, perhaps 600,000 and above, depending on the part of the country you're in. But if you're buying a $3 million McMansion and getting a $2 million loan on that, that would be a jumbo loan. It doesn't kind of fit other characteristics that normal house loans fit into. And so if you get jumbo loans and pool those together, they're used to create what are called private label securities. So not a Ginnie Mae security, but it's going to be a private label security. It's going to have different characteristics. They're going to be large loans, different interest rates, and different risks. And then conforming conventional loans, these are going to be the ones that aren't jumbos. So I think the jumbo limit in Colorado, for instance, is a loan up to $454,000. So if you're getting a house and the loan is going to be less than that, and otherwise it kind of fits all the characteristics of a normal mortgage, it would be a conforming conventional loan. And those would get bundled together and turned into agency securities. So we kind of have the three flavors: Ginnie Mae, private label, and then agency securities, which would be Fannie Mae and Freddie Mac. The next part here, after we've pooled these things together, we're going to securitize the pools and sell securities. So once you've put all the loans together, you turn them into mortgage-backed securities, which are in many ways like a bond. You're collecting maybe $100 million worth of these loans, and you're going to slice them into, oh goodness, let's just say 100 slices. It'd be many more than that, but let's just say we cut it into 100 slices, where every buyer of one of those slices is getting $1 million worth of loans, but it's all kind of homogenized. You're not getting loan X, Y, and Z that comprise $1 million in loans. You're getting 1/100th of every loan in the pool. So if there's $100 million in that pool, you're buying $1 million worth of it. You're getting 1% of basically every loan in that pool. And so that's what's happening with securitization. You're slicing and dicing all of these things that have been jumbled together, and every investor is getting a piece of all of the underlying loans in that security. So on to number 5 here. Servicing loans while they exist, that's an important part. Servicing rights are a valuable asset, and that is a part of any loan. So when you collect payments, you send the money to the security investors, you make sure taxes and interest are paid, you manage delinquent borrowers, you deal with foreclosure. All of those things are involved with servicing, and you get paid to service loans. And it's somewhere on the order of 25 basis points to 50 basis points. So 0.25% to 0.5% of all of the value of that stuff. So if you had $100 million of loans that you were servicing and you got paid 0.5%, that would be $500,000 every year to service those loans. Now, there's an important note here down at the bottom. These things can all be unbundled, and that is to say that they can be done by a number of different firms. So this isn't just necessarily just one firm doing all of this stuff. There are large lenders, perhaps Wells Fargo's and the Chases and Citibanks of the world, that can do all of these things. They can make the loan commitment, fund the loan, pool the loan, create the securities, sell the securities, service the securities, etc. But frequently that's going to be sliced up and parceled out to a number of different firms. So there are firms that just specialize in servicing. There are firms that specialize in warehousing. There are firms that specialize in selling the securities, etc. So let's move on here and talk about some more terms: a mortgage broker and some mortgage-backed securities, and we'll probably stop there. So a mortgage broker is just a middleman that goes between a borrower and a lender. They are paid on a commission basis, typically through origination fees. We've talked about those in prior videos. And they get paid basically only when a loan closes. So they're very much like a salesman, a car salesman, or any kind of selling person. And they kind of have a wide field of lenders that they represent. They know a lot of different programs, and they're trying to match up the borrower with a lender program that kind of meets their specific needs. And so they're supposed to be experts in the mortgage world, and they kind of bring together borrowers and lenders, and that's how they get paid. Then mortgage-backed securities, we've talked a little bit about this already, but these are where you pool similar mortgages. So similar in term, that is to say you'd create a pool of all 30-year mortgages, a separate pool of all 15-year mortgages, etc. And then the interest rates are going to frequently be relatively close to each other. So you might have one pool that's 30 years, 4.5% mortgages. Then you might have a separate pool that's 30 years and 4.25% mortgages. These might be from a single state or from a larger geographic region. So you might have California representing one pool, or you might have the Southwest representing a pool. If we assume that 4.5% is the interest rate on all those loans, then we have this thing called a pass-through rate. And it's always going to be less than the interest rate on all of those loans. So the pass-through rate might be, for instance, 4.125%, and that difference between the 4.5 and the 4.125 is going to be kept by the servicer. That's their fee. In this case, it would be 37.5 basis points. So I'm going to stop there, and we'll pick up with looking on at these when borrowers make a payment. We'll continue on through these notes, and I'll see you next time.